Okay, all, it's time to start. I want to thank Tradeovate for putting this event on. So thank you, Tradeovate. Before I get started, I'd just like to introduce to Bastian from Tradeovate, who's got a few words for you. Bastian?
Yeah, thanks, Pete. Welcome, everyone. Yes, thank you for joining us today. We are very excited to have Peter Davies with Jigsaw Trading presenting Becoming a Better Trader in just 2 weeks. Before we get started with Peter's presentation, we would like to talk to you a little bit about Jigsaw and how Tradeovate work together. So the Jigsaw Day Trader is fully integrated into Tradeovate. What that means for Tradeovate account holders is they can use both Tradeovate and Day Trader at the same time with the same Tradeovate login. So because of this setup, unlike other firms, there are no additional order routing or market data fees. Traders can also choose from one of Tradeovate's 3 pricing plans that will cover trading on either Tradeovate or Day Trader. So you can have both platforms running at the same time. So for active traders on Day Trader, Tradeovate offers membership-free pricing in which traders pay a standard commission as they trade. We also offer 2 subscription-based models, the active trader, where there is a flat monthly fee, as well as a reduced per side commission. And lastly, we offer commission-free for a flat fee with no commission at all. In all cases, standard exchange, clearing, and NFA fees do apply. These plans can be found on our website under the pricing section. So the Tradeovate Jigsaw integration also means that traders have access to Tradeovate's market replay feature. This feature is included free in the active trader subscription and $49 otherwise. It allows traders to replay any session back to January 1st, 2017. And what is unique about Tradeovate's market replay is that it's cloud-based, which means no clunky downloads, and it can be started, stopped, and the speed adjusted as needed. So it's very easy to use, and lots of both Tradeovate and Day Trader users enjoy using it. Before we get started, let's just go over the standard disclaimer. So brokerage services are provided by Tradeovate. Tradeovate is a member of the NFA and registered with the CFTC. This is not an offer or solicitation for brokerage services or other products or services in any jurisdiction where Tradeovate is not authorized to do business, or where such offer is, or solicitation would be contrary to local laws and regulations of that jurisdiction. Futures and options trading involves substantial risk of loss and is not suitable for all investors. Investors should understand the risk involved in trading and carefully consider whether such trading is suitable in light of their financial circumstances and resources. Past performance is not necessarily indicative of future results. So after the presentation, we will open it up for questions, and feel free to submit those in advance, and we will consider those, go through those, and respond to them when possible. So we would like to now present Pete Davies from Jigsaw Trading.
Thank you, Bastian, and welcome all. What we're going to do today, we're going to attack an issue that probably most traders don't know about, and that is the fact that the large percentage of retail traders out there would fail even if they were handed a profitable setup. Okay, now before I do that, let me explain how I know this. So this slightly overweight fellow is me at a prop firm in London, and that's one of a number of prop firms I work with. The people that I work with at these prop firms, I work with the traders, I work with management, and I also work with the people in charge of the education and trader development programs. Just, I work with different levels of people just for different reasons, basically. And I also work with retail traders, people at home, often who year after year have been trying and failing to profit from trading. So today, I promise to give you something that will help. I'm not going to promise to give you something you will like. It's going to be something that will improve your understanding of the market in a few weeks. And it's going to give you something that's going to make you finally feel like a trader. It will be something that's probably outside of your comfort zone because it is something you won't have done before. But this isn't going to be your typical trading webinar. Now, your typical trading webinar is quite often about a magical pot of gold that will make you profitable tomorrow for zero effort. Now, a lot of the trading webinars you see out there, they're not sponsored by brokerages, because a lot of the people that are doing those webinars, they would not be able to get through the compliance regulations, right? So there are certain things that you can and can't do when you're associated with the brokerage. There are certain things you can and can't say. You can't BS, for instance, okay? So today we're going to talk about things that are true, and I am under regulatory, well, I've got TradeAware observing me. We've already gone through the content. So basically everything, this is CFTC compliant. This is not the magical pot of gold that will make you profitable for zero effort, which is what most trading webinars are. This is something different. So we're going to talk about actually being rewarded for the amount of effort you put in. So what I'd like to do now is just relax, because we're not going to get you all hyped up. We're going to keep it calm. We're going to consider something together about the realities of becoming a successful trader, just like all the traders that I know at various levels in prop firms. Now, everybody in this webinar today, myself, Bastian, you guys all here, you are all currently sitting there with your skill as a trader as a result of your own combined experience, right? So for all of us, everything we've already tried in trading has got us to where we are now, whether that's profitable, whether or not. And that goes for me, for you, everybody else. So if you aren't where you need to be in trading or where you want to be, doing more of the same things you've already done might not help. And for a lot of traders, we need to kind of give a kickstart, a jump start, and do something different. Okay, now I say do something different, but I really need to qualify that, because we're all the sum of our own experiences, so we've all been doing things different. So different from what? Well, in the retail world, a lot of traders that get nowhere focus on this question and only this. Now, I was in a prop firm, it's actually going back a couple of years now, where one of the traders made a 15-minute trade in the Mexican peso futures. Some of you might even not know there is a Mexican peso futures. And I thought it was quite funny, because it was a guy in London. And I said to him, what on earth do you know about the Mexican peso? And I think the profit on the trade was actually just under $20,000, but it's a prop firm, it's trading size. And I said, what do you know about the Mexican peso? And he said, well, it's his style. It was going up on news, and he got in, he bought it. Now, it doesn't mean you should go out and jump on every move up in the Mexican peso, but it does highlight a couple of important things. First of all, a setup, any trade setup you have must have a cause, right? There has to be a reason for others to buy after you. Quite often that reason is news. Sometimes it's that traders are trapped. Sometimes it's that you suspect traders are about to take profits. And there's a whole host of reasons why a market might do something. There's a whole host of causes. So that's the first thing. The second thing that's a truism about trading is you have to get good, right? So if I gave you a setup today that yielded like an average of 20 ticks a winner, you'd most likely, if you tried it tomorrow, you might make 5. You'd miss some trades. Your fat fingers would buy instead of sell sometimes. You'd take some trades that didn't really fit the rules, but you're kind of hanging around for a trade, so you kind of bent the rules to let you take a trade. You do that kind of thing. So if I gave you that setup tomorrow, your trading wouldn't really reach the full potential of that setup the first day you traded it, or the second day, or the third trade. And that's the reason that a lot of things traders try appear not to work, right? It's not that they don't work, but it does take time to develop the skills to trade any specific setup. Now, obviously, as you become more adept at a trader, it becomes easier to adopt new setups, because setups are basically generally composed of, a limited set of components, right? So what happens is you find something in the market, or you read about something, or somebody teaches you something, you try it and it appears not to work. So most think the issue isn't that they lack skill in execution, but they lack rules. So what do? They add on more complexity. They do more stuff. They learn more things superficially, but nothing in depth. And that's why you have a lot of traders with 6 screens jam-packed full of indicators, loads and loads of stuff on there, but they still lose money. Now, if we go back to this trader, there's not many charts. This is a trader, a very, very successful trader. And these are the only charts he's got. This is news, this is news, this is news. This is all market depth, very few charts, right? And no indicators, right? Oh, I think there's a moving average there, okay? It's quite the opposite of what you see with the retail traders. Now, professional traders that work within prop firms, they're mostly just trading off the depth of the market. And it's a massive difference between a retail trader and them, just in the amount of information they use to trade off. They try to trade off the least amount of information possible, whereas your trader at home keeps trying to stack information on top of information on top of information to make trading decisions. Now, of course, the entry is an absolutely essential element of trading, but to develop as a trader, you need to learn a complete method, and the entry is just one component of a method. It's not necessarily that you have to have a complex method, but you just need to learn it deeply. You need to understand it. You need to know when it works well and when it works not so well. So if any of you are struggling in the market today, trying to do the same thing that worked last month, it's not going to work, right? Absolutely. Almost all techniques that work in a slow market are not going to work on a day like today. So today is a day when it works not so well. What does a prop trader do on a day like today if it's not his specialty? Probably has a few tickles at the market, realizes it's not for him, goes and takes the rest of the day off work. So volatility in the market sweeps up and down, and you learn your method. You learn to trade it in different conditions, or you learn that some conditions is just not appropriate for the method. So what you do, you learn a method, you trade it, and you analyze the results. This is one of the most important things. You analyze results. In a prop firm, new traders have to look at their results at the end of every day. They have to actually do a review at the end of every day, okay? And this is the biggest part to becoming a better trader. You use the results to teach you how to progress. So you learn, you trade, you analyze. And it's the analyze that teaches you something else, which you trade and you analyze, and that teaches you something else. And it's just a cycle that you go through, a cycle of continual improvement. So the theory or the reason for getting in is your starting point, but you have to let your experiences as a trader teach you too. So with most retail traders, what they do, they focus mostly on finding some rules to define an entry so they can click buy and sell, and they don't actually have a process of improvement, and therefore they have very little chance of improvement. So it's like, for most people, it's like profitability is a switch. It's on or off. That you just need, you haven't found the right switch yet that you can find, and tomorrow you're going to be profitable for the rest of your life, right? Most retail traders also are really not taking it seriously. And that doesn't mean you personally, you might be taking this seriously. A lot of people just want to go home. They don't want to talk to the wife. They want to lock themselves up in the spare bedroom, click buy and sell after work. It's a hobby. And anything other than clicking buy and sell doesn't really seem that interesting to them. And it's fine. But for the serious trader, you actually do need a more rational approach to learning and improving. And I'm going to tell you why. Is because the potential upside is huge and the potential downside is huge too, okay? So this is my experience of meeting traders, right? So we won't dwell on the blown up accounts or these guys here. I often meet guys who say things to me, I really need to make profit. I've lost $25,000 and haven't told my wife yet. Recently worked with a trader that lost 2 properties and $200,000 in cash. He'd actually sold his properties. He had sold 2 separate properties to fund his trading and lost it. And you don't want to go there, right? And most traders don't. Most traders take a few small losses on the chin and then kind of wise up a little bit. But what they do use, most people do end up taking a lot of precious time trading sim for years and years and years. So in terms of the traders that I work with, the first level of what I'd call success is this one here, which is I'd have made money if it wasn't for the commissions. And it's very common for those trading multi-leg spreads. So if you break even and paying yourself your commissions and actually paying off your commissions, give yourself a pat on the back, right? You're actually further ahead than most people. Now, in a professional firm trading outright positions, they usually target 200 to 300 a day, which means basically the trader has to earn, that trader has to be looking on sim to making roughly $1,000 a day before they can get given their live account, right? And I'm talking bricks and mortar prop firms, actual building that you go to and not like a virtual prop firm. The first profit's $200 to $300 a day. Typically, if you're making $1,000 on sim, you'll probably be $1,000 a day on sim. You'll probably be making about $200 when you go live. Generally speaking, your profits are divided by about 5 when you get onto live trading for a lot of reasons, the stress, stuff like that. But the first target for a prop trader is a couple of $100 a day with, something like $1,000 day drawdown that would kind of see you going back to sim. And, it's an imminent threat basically that you move back to sim and you have to have very, very tight control of risk. And again, what they tend to do in the firms is give them a single strategy and a very, very narrow focus. So it's walk before you run kind of trading. Now, as the traders progress, if they do progress, kind of the next level that you see some people plateau is when they get the 2K to 4K days. Now, remember, this is trading firms' money, not their own money. Losing days are absolutely still possible, but the trader has now reached the level of success, kind of puts them ahead of most or almost all retail traders. And generally speaking, what happens at this point, they've got a wider range of markets and a wider range of setups. They can trade bigger size and they have more leeway in terms, size to trade. And also at this point, the other guys, the larger traders in the firm, are kind of paying a bit more attention to them and helping mentor them because they know they've gone past this level here. Okay. Now, people scale up, they throw more money at them, we get more size, more trust from management, more aggression at scaling into positions. So we get the guys who are on the 10K plus days. Now, what is the difference between this guy and this guy, right? And the skill really, when you get further along, we got first profits here. The skill that really defines the trader who's going to be, the firm thinks he's going to be there for years, and the trader who's going to blow out after 9 months of profit, is the ability to switch modes quickly as the markets change pace. And the way I see it, it's a bit like a crocodile. A crocodile might be just sitting there stationary for 6 hours, and you throw a chicken body at it and boom, it moves instantly. And it's that ability to switch modes as the market changes pace that only comes through screen time. Okay. And I've seen traders at this level, we're doing 10K on an average day, making 40, 50 on a good day, but of course they've got the firm's money. Okay. Now, this is important because there is a fear factor involved in trading, and it is a skill in itself to push you past through your comfort zone as a trader to get to the next level. So typically in a prop firm, when the prop firm says to the trader, okay, we're going to increase your risk, we're going to let you trade more size. When that size increases, when they trade those bigger positions, their performance decreases, right? So they do badly at first. So they move up, but just that extra size, even though it's not even their money, generally ends up turning into a bit of a rough patch. And then they have to work through that rough patch. And then the next time they grow, they have a bit of another rough patch. But then as they start to scale up, those rough patches go less and less. It's just adjusting to a new level of risk and potential reward, right? Now, there's all levels in between, but the elite traders progress to the level where they're regularly pulling in 100,000 a day, right? Now, in some cases, I've known traders that have become a significant percentage of all trade on an individual market. Met just a few of these people. One trader I know recently had his first $1 million day. Another trader I know, at one point, he was 30% of all the volume of one of the markets on the Singapore Futures Exchange. Now, there's a reason you need to understand this, a really important reason you need to understand this. First of all, you have to stop the kind of minimum wage mentality that a lot of people put themselves into. So often I ask people, where would you like to be in your trading in 12 months' time? And they say, well, hopefully at that point I'll be breaking even, or I want to be paying for my commissions. And if that's the case, right, if that's your goal to be break even in 12 months, get a part-time job at McDonald's, because it'll pay more and you'll meet some people. So almost all of you got into this at least partly for the money. I know there's some people that say, oh, well, you've got to love trading or whatever, but you got into this for money. So if you want to earn $1,000 a day, don't be shy about that aspect. Pin it on your wall as a goal and give yourself that goal. Because considering how much time and effort you're going to put into this, there should be a decent goal at the end of it and a decent reward. Plus, if you're putting in the time, taking it seriously and putting in the effort, it's going to be a lot easier to do the things you need to do if you've got sights on a decent goal. But more importantly than that, I want you to think about something. The skills that these prop traders get taught to earn $200 to $300 a day, do you think they're the same skills that get an elite trader to the point where he's cornering 30% of the market, right? Do you think it's just the same method but bigger size? And the answer to that is absolutely not, right? And the other question is, who is teaching these traders? These traders, like the trader I know that cornered 30% of one of the Singapore futures markets, who taught him how to do that, right? Is it like the teacher in his first prop firm taught him that skill? And the answer is nobody taught it, right? There's no class for that. There's no course for that. Nobody teaches you how to get to that level. It's just where traders ended up, just a few elite traders. But it's a commonplace for a few elite traders as well. So they started off small and frequent, then they gradually grew, which is what you need to do if you're not yet profitable. They didn't just trade, they always used their results to guide their future trading. So every time they traded, every trading day was a learning experience, and they just had that feedback loop. So the more they learned, the better they got. And they just learned enough about the markets where they were able to throw an immense amount of size. Now, the guy in the prop firm that taught them those first few setups could not do that, right? And I challenge you, if you ever find a big trader, ask him who taught him to trade the way he is with that size. And he'll say nobody, right? So I want you to understand that to get better as a trader, it's not an uncommon thing. Nobody's going to do it for you. Nobody's going to be able to teach you how to get to your goal, but people are going to be able to teach you how to get to profit and how to make those first steps. But you have to take responsibility for your development as a trader, right? Which is why the first step in our 2-week plan is to do what the prop traders do, what the prop firms do, and it's to select a single market to look at, right? So we're all in different locations. We've all got a certain time of the day to trade, and we all have different personalities where different markets suit different people. Now, the time of day is really important, and one of the things I would say, if you've got like if you're in the US, for instance, and you're getting home in the evening, and your plan is to, you're getting home in the evening, the US markets are really quiet, and then you plan every evening to replay the morning session. What is your long-term plan, right? So if you get profitable replaying the US mornings and you're not actually available to trade at that time, what's your long-term plan? Are you going to give up your day job because of your replay profits? And I would say, I hope not. So the best thing to do for everybody is find a market to trade when you have the time available, right? So this isn't rocket science. As most people are working, then the time you have available, it's the rest of the time that you're not working, right? So in US evenings, there are Asian markets you can focus on. For those on the West Coast, you might have to wake up earlier, trade before work. It has to be said, the US markets are more lively now in the evenings. If you're in Europe, you can trade the US close after work. Now, in terms of time to commit, if you are working a full-time job, 2 hours a day is a really good target for this 2-week plan. After the 2 weeks, we're going to add some review time to that 2 hours, but I'm going to give you something now that you're going to do for 2 hours a day, and anything more than 2 hours a day for somebody who's working full-time is overkill. So there needs to be some balance, and 2 hours is a lot of time to be intensely focused on something. So you need time to unwind afterwards. And even if you're tired, 2 hours of intense focus is enough. So what you're going to do is you're going to find 2 hours a day that you can commit every day for the next 2 weeks. And based on that, you're going to have a range of markets to choose from. You then need to narrow that down based on 2 factors. First of all, which market has the sort of volatility profile you like? Do you like fast markets or slow markets or something in the middle? And then which market is likely to give you multiple setups in that 2-hour period? Because to get good at something, you need to repeat it many times. One trade a week is not going to cut it. You'd need to have superhuman patience. If you were just trading one trade a week, you would need to really allow, it's 52 trades a year. It's a very, very small amount of data to work off. And it's also, a year is a very, very long time to work without changing or tweaking your setup in any way to get good statistics for the year to evaluate what you're doing. So I actually have trouble getting people to go 5 days doing the same thing with their trading, right? So what we need repetition, because we need feedback as soon as possible to tell us if what we're doing is working or not. Now, let's backtrack a minute, because I think before we actually talk about setups, we need to actually define what we mean by a setup, or what makes a good setup. And I think the first thing to say is it's actually easier to talk about what makes a terrible setup. And the worst setups are the ones that are the most complex. Now, what happens, especially nowadays, right? We've got a lot of traders who have gone out, and there are some kind of high profile, well-respected gurus out there. And what people are doing now, they're going out and they're taking volume profile off this guy, market profile off that guy, footprint off this guy, and putting them together, all those things together, because like each guy sounded really, really clever. Okay, so they're doing multiple time frame analysis, they're using day types, they're doing pre-market prep, they're using market profile, they're using volume profile, and they're putting all these things together and just mixing them up in a mixing bowl. And there's so many factors that you couldn't actually make consistent decisions actually in the moment, okay? And that's aside from the fact that none of the factors have been individually tested by the trader who's using them, other than that guy sounded smart. So you heard a guy who told you all about volume profiles, he sounded really smart, so you're gonna use that as a basis without even testing it first to see if that's actually valid, right? Now, if you walk into a prop firm, a lot of the guys there, all they use to trade off is market depth. There will be some guys on footprints, and they will look at a few charts before the market opens, and they will look at the news extensively before and during the market. But what they actually use to make trading decisions is actually very simple, and it's just the ebb and flow of the market. Now, I'm not saying you can't use market profile or volume profile or any of the things I mentioned earlier, but you sure can't use too many things, and you can't use anything if you can't quantify how well that thing helps, okay? So it's not enough to think one of the components of your setup works. You actually have to know, right? Because if you don't, you're just basically guessing because somebody else told it to you. So when I talk about a setup, I'm talking about using a fairly rigid set of rules, but limiting what you do. Something higher frequency, something with less factors taken into account, something where you're not really trying to guess what the bigger picture outcome is, but absolute limits for this next 2 weeks are going to be one market and one setup in that market. And of course, this is where people in the audience think, well, to hell with that guy in his opinion. But if you've got 20 different setups that all don't work, or you're just trading off the cuff with no real plan and you're not making any money, you just need to consider scaling back a bit just for a couple of weeks and see what happens. So if you're not making money now with the multiple setups, just go back to the best one, right? If you can't make money on one simple setup, you're not going to be able to make money on 2, 3, 4, or 5, and you won't make money trading some kind of general opinion of where the market might end up. Now, I hear a lot about like discretionary trading, and people always say to me, well, a discretionary trader, that just kind of means I can get in anywhere, doesn't it? I'm just like trading a general guess. So with discretionary traders, most of the prop trades I know are discretionary. They will have rules. They will absolutely have rules. Some of the rules might be, if the crude inventories are up and the crude oil starts to dive because we've got inventories going up, I'm going to start to try and build a short position. Okay. And that's like, it doesn't exist. It is discretionary, but it is still a set of rules, right? So we're going to have some rules, and we're going to stick to one setup. And the other thing I want you to remember is that like this is a journey. So when we talk about being profitable, that is not the end game by far. Okay, so the guys that corner 30% of the market all started off with a few small profits a day. So being profitable is a milestone. And the sooner you get to it, the better. And it's just a platform from which you improve. So the setup is basically something you've observed in the market that you believe causes a reaction. And I say believe because if you're not profitable yet, you probably don't know if your setups actually cause a reaction or not. But in 2 weeks' time, you will. And if you don't have a setup, choose something with cause and effect. So fading icebergs, momentum, breakout from small ranges, fading volume spikes. They're all very common things, like cause and effect things that go on in the market, that are very, very common. And you could just pick one of those to observe. Okay. What are we going to do next in our plan for 2 weeks? First thing we're going to do is we're going to stop trading for 2 weeks. Now, I know nobody likes me now, but I want you to just stop here and go back a few seconds and just think about what came into your head when I said that, right? So many of you, when I said you're going to stop trading for 2 weeks, you'll have felt shock, revulsion, or you'd have had some kind of negative reaction to this idea. And some of you just basically decided to not listen to anything else I tell you. So seriously, just go over now what came to your head at the mention of not trading. Don't associate with that with negativity. Just observe how you reacted. It's not a good or a bad thing. It's just a thing, right? And I know this. I've taken many traders through the process I'm going to show you in a second. And this is the one thing they have the most trouble with, right? So if you're a net losing trader, the chances are that you equate clicking buy and sell to trading, and that anything outside of clicking buy and sell is not trading. Clicking buy and sell is working. Clicking buy and sell is progressing. Traders that have blown up multiple accounts and have gone nowhere in 5 years still feel this way. If you tell them to do anything other than click buy and sell, they're like, well, that's not trading. You know, why would I do that? And it's an inground behavior. And it's problematic because the people that think what trading is about clicking buy and sell, they're the very people that need to do this, right? And the thing is, the reason it's problematic is because of that whole thing I said at the start, right? If I gave you a setup tomorrow that on average netted 20 ticks a trade, you probably wouldn't make any money of it when you started, right? So you need to discover if an edge works before you start trading it. So you can observe successful and failed setups without emotional attachment, because losing traders are continually making bets on the market where they have absolutely no idea of the probability of the outcome. So they have a bunch of things that they believe influences the market, but they have no evidence. They don't know how often they influence the market, or how far. What's the scope of this setup? Does it create a 20-tick move on average or a 100-tick move? Or if the opposite happens enough to reverse the setup? So it's not just that they don't know the win rate, they don't know the best approach to scaling into that position, the right stop size to use, lots and lots of things. And if you think sim trading will tell you the win rate, just think again, because unless you're a robot, your sim trading will produce win rates also much lower than the setup has available to start with. Because only when you start to execute perfectly can your win rate match what the setup gives, and that just takes time, whether it's sim or live. Because even when you have a great setup, it just takes time to practice it. Now, the other thing I've mentioned, the word edge, right? And there's a lot of confusion about what trading edge is. In fact, in most of the webinars I've seen, when people have tried to describe what an edge is, I've always come away scratching my head because I didn't actually understand the description, let alone what they were trying to say, what an edge is. So I'm going to give you very, very simple terms what an edge is. An edge is being able to see something occur in the market in time to be able to exploit it. And of course, we're talking about repeatable edges. Now, being able to see something doesn't necessarily define exactly how you're going to trade it, right? So you might have seen, like I'll show you in a while, an open market setup. I'll give you the rules for it, right? And when I was watching the market open, I'd watched it over and over and over again. I was watching a behavior that I'd seen over and over and again, but actually figuring out the rules to trade it took me a little bit of time. So I knew the setup, I knew what was going on, but to actually define good trade rules, it actually was a completely separate task. So what we have in the market, we have influencers, right? We have factors that we believe create movers in the market. Things like trap traders, things like ranges breaking, things like a range breaking and a head fake when we go back into the range, where basically traders are getting trapped. News influences the market. Economic releases influences into the market. So we all look for influencers in the market, things that we think create moves. And then we have trading rules that we use to exploit the results of those influencing factors. And we don't expect those influencing factors to work in our favor every time, but we just need them to work in our favor every time enough to make a profit. Okay, and then we combine these factors because we think there's an edge. So what is it that's usually missing? Well, the missing piece is an understanding of the reaction caused by these factors. And without knowing that, any trading rules are just guesswork. And you might say, well, that's a bit daft. You know, if I see an iceberg on the bid, you know, I expect the market to go up. And I agree with that to an extent. But what's the scope of the move? Is it like if I see an iceberg on crude, markets pull back, I see an iceberg on the bid on crude and I buy it, what's the scope of that move? Is that iceberg going to cause a 5-tick move or a 3-tick move or a 50-tick move? You know, you might observe it once, you might see a pullback and the market might go up 300 ticks. But it wasn't, that 300 ticks wasn't just because of that one iceberg you saw about that entry point. So you've got to see that kind of entry point setting up enough times to kind of average out and figure out, okay, what is the scope of it? What is the likely upside of this move? You also need to know what's the failure rate. Okay. You also need to know what other factors appear to help or hinder the trade. Market conditions is the biggest one. You know, the market conditions we have today are quite wild. And you know, a lot of people are getting taken out. So the people that know which conditions their setups working best are better off because they know when to, you know, put the foot on the gas and they know when to just take a break for the day. You know, so we could have specific market conditions like now that are driven by macro news with the coronavirus. You might get market conditions after a news event. You might get market conditions before an announcement, like before the FOMC. You might get market conditions at the open. You've got market conditions at lunchtime, or lots of different times that the market changes at pace. Now, many traders have the influencers and they have the trading rules, but they don't really understand the reaction to those influencing factors. In fact, there's some cases where if they'd actually studied their setup in detail, they would actually reverse the rules. So the influencer is there, but after study, they find that the failure of the setup is actually the better edge. So even if you're convinced that someone's trying to hold the market, you might find that betting against them is a better bet than joining them. And just to give you an extreme example, think about this scenario, right? And I'll say in advance, this is obviously an extreme example, and that's intentional. So let's say you have a trade that works 9 times out of 10, okay? So your winners get 50 ticks, but your losers lose 500 ticks, right? So there's no edge in that, right? Out of every 10 trades, you lose 500 ticks, but you make 450. And if you sim traded it, you'd be disappointed. But like, let's say you went in looking at a setup and then you found that these were the results. What if we just traded in the opposite direction? So the winners were now 500. And you say, well, that's still going to be close to break even. But then what happens if we added scaling into a position? Now you've actually got something that you could work with. So the 50 ticks becomes your stop loss. The 500 ticks is your target, and the winning trades through scaling in would have more size than the losers. That would turn it into a winning system. Not that you'd want to trade it, it's just to illustrate a point. And it might seem like a silly example, but you do have to understand the failure rates and how far the market moves your way and against you to decide how to execute. And this is why a lot of people are losing. They find rules and then they trade them. They've got no expectation of the outcome to define the rules, and they don't let the market guide them or let the market refine the rules for them. They expect the market to bend to their rules, right? They don't bend their rules to the market, and they don't have any mechanism to do that. So here's step 3. What you're going to do, just pick one setup, right? One behavior that you see in the market. Just could be, just take a breakout or whatever. And you're looking to see in real time how often that setup occurs, what the outcomes are, what else was going on in terms of news, market state, and what like correlated markets were doing. So if you're trading the S&P, what the NASDAQ and Dow were doing. So make notes. Doesn't matter what form your notes are, but the kind of notes you'll be able to use afterwards. If you're the analytical type, then make statistics. If you're artistic type, draw a picture, right? And the key here is not to judge, to be an impartial observer. So what you're trying to do in 2 weeks, you're trying to actually gather some intel on your setup so that you can then define the trading rules. Now, of course, when you do this, there's going to be a temptation to trade it. And with the people that I work with, what I tend to do is I'll help them choose something to look at. So when people come to me, if they ever come to me for help, some people pay me to help them. Some people I just do it for free because I'm sitting here on my own, like all you guys. A lot of people, some people will come to me with 20 setups. It's like, we really need to kind of narrow that down. And sometimes they'll have a few preferred setups. So we choose some of the most likely candidates. Some people have setups that they really, really believe in, and we start there. And some people say, I've got nothing, and they're the exception. So we just give them a place to start with. Okay. So here's a good example of a trader that found over a 2-week period, he could actually anticipate by the end of the 2 weeks whether the setup would fail before taking it. And he ended up with 2 setups from one. He was watching one event in the market, but he could tell whether it was which way it was going to work out, right? So when people do this and actually start looking at the markets, the feedback is generally one of not quite being able to believe what it is they're seeing. That this kind of 2 weeks activity is some kind of magic trick, like, how come I didn't see this thing before? Guys have been doing 5-10 years. Like, I just didn't see that before. Well, how could it possibly be this simple? And the fact is that the trading got in the way before. And if you remove the trading from the equation, you remove the emotion. It's still not guaranteeing you'll be profitable, but it does show you that it's possible. So this comment here is typical. He's not only seeing the setup as potential, he's also seeing other factors that he thinks are going to help make decision. And it's a little bit depressing that traders spend years getting nowhere, and that can actually see these things in a few weeks just by taking a step back, right? Now, let's look at some stats. So these are stats from a trader that took his 2 hours a day of screen time, and his screen time was in the US morning. He's a trader that likes fairly slow markets, so he looked at the ultra bonds. Now, this was his setup, a setup that was not working for him. Okay, I did help him choose which one to set up from his range of setups, but I really didn't do that much. I just took the one I thought was had the most promise, and so that was my contribution basically. So the key thing though, this guy was not profitable, and he was doing what a lot of people do, looking at many systems, not focusing on trade frequency, not focused on time of day, not looking at market conditions, trying to find lots and lots of setups to trade. And actually, when the setup wasn't really there, he'd kind of bend his rules a bit, that's to let him take the setup. So what he did, he took a step back and he didn't trade, and he just watched the market and saw how often that setup appeared each day and how often it failed for a 2-hour interval only. And so for a 2-hour interval on the ultra bonds, we can see this is the number of trades per day. That's actually decent frequency for a market like the ultra bonds. I mean, these 11 trades in 2 hours is quite exceptional. That would have been a really fast day. Okay. So we can see how often the setup appeared each day and how often it failed. Right, we've got the failures here. The ticks profit are all absolutely theoretical and all based on if it entered with a market order at the point he could actually see it was setting up. So if he saw it was setting up late, he had to put what the market was trading at that time. No optimistic fills. So over the 2 weeks, there was a theoretical 240 ticks profitable trading one contract at a time on a contract that's like $32 and change per tick. So this is somebody that had gone 5 years going nowhere, and in 2 weeks' time, he's got this in front of him. And that's what happened. So after 2 weeks, he's actually got evidence now that over a sample of 63 instances of a setup that there is edge in what he's looking at. And that's more progress in made in 6 months of sim trading. Now, it wasn't profitable yet, but he can clearly see, actually, there's some promise. There is some promise in this. There's something he can work with. Now, let's look at another one. Different guy, completely different format, completely different technique. And having these statistics helps to give people their confidence back. Suddenly they know how to look at a market, how to assess a setup. They have a degree of confidence that the market that's kind of previously beaten out of them. Now, let's say you did this with 5 setups, right? You've got 5 setups. You did this over 2 weeks with 5 setups. You found that 3 of them were absolutely rubbish and 2 of them had promise, and you could actually see, you know, a reasonable amount of ticks made on 2 of them. That's actually moving forward in your trading. So ask yourself, when was the last time you actually moved forward in your trading and were able to filter out and spot which setups would work? And for a lot of people, it's been a long time. Okay. Now, what we have though, and it's a big problem with traders, because probably the 2 biggest problems I have when I talk to traders is, first of all, they've never kind of quantified the rules. And second, they love to take off-plan trades and keep changing what they're doing. So some traders absolutely love changing their way they trade. They like to change their charts, their time frame, their trading rules, their approach, the time of day they trade, the charting package they use. And it varies from person to person. But with the sort of plan we're discussing here for 2 weeks, it's just a matter of being consistent for a 2-week period, right? If you do 1 week of analysis of your setup for 2 hours a day, and then you change the rules, you're just throwing away that first week's work, okay? So what I'm going to show you now is this is actual communications from somebody going through this 2-week process really badly. So we've sat down, we've chosen a setup, right? And we said, right, for the next 2 weeks, for 2 hours a day, all I want you to do is write down how often that setup occurs. Write it down as you see it. If you miss it, just write down that you missed one. But you've got to write down the price when it occurs and where the market went and kind of how far the market went against you for the ones that don't work. That's all he had to do for 2 weeks. And we sat in a meeting and he agreed that that was all he was going to do for 2 weeks. He's just going to observe for a few hours a day. And for the rest of the day, he's going to actually take his mind off trading. He's not going to obsess over it anymore. So we had a decent setup to follow. And I thought there was actually a pretty good chance that the trade location he was using would help him discover something, even if it wasn't actually the edge he was investigating. He was looking at the market in a particular place where there would be a reaction. I didn't think it was going to be the reaction he was expecting, but he was looking in the right place. Now, as you can see, he's very diligent in recording his results, but there is a little issue here. If you read at the top, day 1, I got an email. Because when people do this, I say, just email me what happened every day. So he says, I'll watch the market behavior primarily without trading. Okay. Which means basically he's still trading it. He wasn't trading it live, but on sim. And why would he do that? After sitting there agreeing to not trade for 2 weeks, why would he do that? And I think it's because he feels that if he's not clicking buy and sell, then he's not progressing. So this trader literally could not bring himself to have 2 weeks off the buy and sell buttons. He was addicted. Anyway, I got a daily email from him. First 3 days, very positive emails. This is going really great. I'm really starting to see things. And not only can I do the observation like you told me, I can trade it too, because I can do so without impact, right? So of course, when I saw this, it's like, and it's really difficult when you're in this position, because especially with my kind of personality type, I've got an on and off personality. I'm not very subtle. And I'm thinking, what do? Do I just go up to him and say, stop being an ass and just stop with the trading? And the answer is no, I didn't, because it's at the end of the day, we've had our discussion. He's made a decision to do what he wants to do. Nobody likes getting pushed around, being told off. So he's going to have to suffer the consequences and see how it goes. But also at the back of my mind was, well, maybe he'll be the one that can actually do this and trade it, and he'll be okay. So anyway, get to day 3. After day 3, still getting the daily updates, but they were kind of a little less upbeat. And on day 8, I was actually blessed with not 1, but 2 emails. Now, in the first email, he's actually fighting the market. Now, you can see I'm connecting my combine account to the leaderboard today, observed and then traded. I was up over $1,000, being in the top 10 of the leaderboard for a few minutes, I think. And then I freaked out completely. I wanted to stay under the daily top 10, and that led me to fight the market day. And ended up the day being down 1950, right? And he violated it was a 1-up. Sorry, that typo there. Now, I don't know about the kind of way I explained it to him, but he was trying to get the top 10 in the Jigsaw leaderboard, and that seemed to have been one of his goals. That seemed a little bit off scope to me, considering we just said you're going to observe the market for a couple of weeks. And then Also on day 8, a little bit later, the frustration email comes in. And what's he doing now? He's now looking for another method. And this is just so typical of what traders do. Super frustrated. I was thinking what I can change in my trading process. This is a guy that 8 trading days ago was told, just watch the setup. Don't trade it. Just watch it and see what you learn from the market by doing that. It's something you've never done before, and it will benefit you doing it. So he's looking at the Stephen Kelly method, which is something from a few years ago that's on the Jigsaw members page. And he's also looking at this guy, Mr. Gecko. His average loss is $43 versus 786 average winner. So he's kind of thinking, well, I want to do what Mr. Gecko does. Now, what he doesn't know is Mr. Gecko is sitting in a prop firm in Poland, right? So, of course, he's doing well, right? But he wants to do what that. He's scaling, and Mr. Gecko is scaling into his trades, works at a prop firm, a lot of experience. So he's like, I want some of that. I want videos of that. And, you know, of course, what's happening now is the grass is looking much greener everywhere else from where he's standing with his approach of, well, I'm actually not sure what his approach was, right? It's just somebody, it's very typical, somebody who just can't stick with one thing for any length of time. So basically at this point, this is where I had to intervene. And as I mentioned earlier, if you can't make money on one market, you're not going to make money on 2 or 3 or 4 or 5. So this trader made a few common errors. In the first place, he had no idea if his setup had a positive outcome, okay? And that's something you figure out before you start trading it, right? Because otherwise, you are literally guaranteed to lose money. And trade it anyway, even though we said don't trade, and every losing trade made him feel bad, right? So instead of a losing trade being a simple check mark on a spreadsheet, it was a failure to him. It took it personally, right? So when you just observe the market, say, right, this point in the market is where I think I'm going to get in, and I'm going to observe the market absolutely neutrally every time that thing happens, and I'm going to write down what happens. Now, if you're doing that, you do not care if it goes the way you thought it was going to go or the other way, because you're just gathering intel, okay? If you trade it, you are not going to watch the losers you're not going to be engaged in watching the losing trades as well as you are the winners. The winners are going to make you feel good. You're not going to want to look at the losers, right? It's just human nature, right? So after a few failures, basically his emotions got in the way, just like it does with 99% of people trying to learn how to trade. And there is simply no need to let that happen. So what next? So let's say you stick to this 2-week plan. So you've done 2 weeks. You've observed the behavior of a setup. You've written down the results. You got your end of the 2 weeks, and you will be aware of like some major discoveries, right? First of all, if it was a total crapshoot, you will know by now. What you need to do is at the end of the 2 weeks, you need to sit down and review. First of all, is there merit in what you looked at, or is it just a completely random break-even thing? You know, and it may seem a waste of 2 weeks to find that out, but if you were putting money onto that setup, or you are spending time on that setup, and you find out it's just a piece of crap at the end of 2 weeks, that's going to give you some time to focus on other things, right? In some cases, you're going to find that the setup fails so well that you can actually fade it. In other cases, just the simple fact that this is the first time that you've taken a step back and been a neutral observer of the market, it leads you to a different setup. This is it's one of the most common outcomes, is actually watching the markets in this way. It just leads you towards something else. And I've actually had traders come to me after this and say, you know, Pete, I was watching for that setup, but I've noticed that this has happened. Do you think it would be okay if I looked at that? And it's like, why are you asking my permission? If you actually sat there and observed something happen, it wasn't what you're looking at, but you've observed something else and you now want to focus on it, you should not be asking my permission. This should be your first step into realizing that people who create their own setups are by no means exceptional. They're just people that have observed things in the market and like, wow, I've never looked at the market this way, and I can see this happening, and now I'm actually going to make a setup of it. In many cases, you'll be able to start looking at entry and exit rules. So you might find it's an average win rate with a great risk reward. which case you might want to scale in. A lot of prop traders scaling to positions might be a short-term scalp. You might see it's like only the real potentials like 4 ticks on the S&P. So it's all in, all out, right? If the reward is potentially 50 ticks on S&P, then you probably want to scale in as it goes your way. But you will have the information to hand to make that decision. Then you go into sim. But when you go into sim, you carry on writing down the statistics because your sim trading is not going to immediately match the potential of the setup. So you've got your stats. You know, this guy gets his stats. Let's just go back. He gets his stats here. I presume this means, well, let's go to one that's not in German. This guy here gets his stats 240 ticks. What's the chances of him actually making 240 ticks when he gets onto sim trying to trade those rules? Absolutely zero. He'll be making 80 ticks, right? Because he'll be fumbling his way, he'll be missing trades, he'll be closing trades early, and he'll be making all the mistakes that every trader does. But because now he's got a way of tracking, the actual setup itself versus his trading results, he will always know whether it was him or it was the market that caused him to have substandard results, right? So the one thing you've always got to be able to answer with trading is, was that me or was that the market, right? Did I lose today because the market was really bad, or did I lose today because I was really bad? So sometimes you'll see the setups actually worked, but you just did a really bad job. I mean, I've got a trader right now who's sending me his charts, showing me where he got in, and his entries are absolutely perfect, but he's making no money on his trades because he keeps moving his stops. And I've actually got him now sending me his charts every day. So every day he has to send me his charts with all the entry points marked on, and he knows that I'm seeing how many ticks he's missing out on, right? So he knows that it's not the market. He knows it's him, right? So don't just gut feel the results either. Review. So, when you start sim trading, make sure that at the end of the week, you just have a look back over the week. I often have conversations with traders. I'll say, well, how did you do the past couple of weeks? And I say, well, not very well, really. And then you go and look at the stats, and I was 70% profitable. And I thought, well, how do you quantify that as not very well? And the fact is, he had a few days where the results weren't that good, and that kind of clouded his judgment of the period since we last took. So there are additional steps. What we said is we'd just give you some ideas to take you through the next 2 weeks. Now, you could do this your own way. You could do this my way. But the basic premise is just something that's common sense, right? Figure out something that works properly with a structured approach before you start trading it. Find out the expectancy, how far the market goes your way on winners, how far it goes against you on losers, how you know a loser is a loser, so how early can you stop out on the trade, and then decide how to trade it, okay? But you need to do something that points out clearly whether the things you're looking at work and don't. Just like one of the guys here, which is really a common story. I have in the past had trade ideas which have worked quite well, but all of a sudden wouldn't, and I've ditched them, right? Very, very common, right? Something works for a few weeks and then stops. And the reason it happens is simply the market conditions change and that setup stops working. But when those market conditions come back, it starts working again, right? But now he has a method to evaluate. He can see that he would have actually thrown away the very thing that he's evaluating over the 2-week period. And it's a bit of an eye-opener for a lot of people because most traders have thrown away things that would have worked. And that basically is how you become a better trader. It's not just about finding an entry. That's pretty simple. It's about specializing in that entry, consistently reviewing the results, reviewing how that entry is doing, making sure that your trading experience becomes a learning experience. And then, of course, adding more entries when you become proficient in the last one. So even the guys that are making tens of thousands of dollars in a day, they got there by doing this. They got there by trading and reviewing and trading and reviewing, understanding the market, understanding the reactions of the market before they trade. In fact, one of the biggest benefits of being in a professional trading environment as you start as a trader is that basically they'll fire you if you don't do this, right? I think that's one of the biggest advantages proprietary traders have over home traders. I know home traders, and I will say to them, are you married? Yeah, okay. What I want you to do is I want you to review the results of your trading with your wife after every session. And usually the response is one of absolute horror, right? But that's a really good thing to do. But every prop trader, they've got a manager and they have to review the results of their own trading themselves. And they also have to go to their manager and tell them what they're doing. And if they're changing what they're doing every day, or if they're trading an edge they haven't quantified, they will be shown the door, okay? So they have to take a methodical, more pragmatic approach. Now, I understand what I've told you today is probably not what you wanted to hear. It's a little bit different from your average trading webinar. And if you don't know us, you're probably wondering what the point is. And well, that's what we do at Jigsaw. We basically believe in this process, and we have tools and education to help you all through areas. So what we do at Jigsaw, it's a little different from most. We have a trading platform focused specifically on the type of techniques used by the best proprietary trading firms. We have a chat room where customers meet to improve their trading. And we have the most advanced analytics, so you know if you're actually improving or not. And of course, we have the best order flow education around, I think. And what I'm going to do is I'm not going to try and sell you anything today, okay? If you want to know more about the methods that the professional traders use, just go to this link, jigsawtrading.com/12 lessons. You already know the process that you need to go to. You've probably already tried 1,000 indicators that didn't do anything for you. So if you actually start ready to look into some videos about getting rewarded for your efforts, just go there. It's a free video course. It gives you some trade setups. And if you don't have something to work on today, you'll actually find that within this course. And with that, I would like to go over any questions, so we can take questions on both Davies and Jigsaw, and Bastian will enter any on Davies. So let me just go through the questions. Lots and lots of people from lots and lots of different countries. I am recording the webinar, and I will send the link to Davies. Yeah, my audio is set to British accent. I'm just going through the questions. I have to find some questions. Yeah, and I can see we've already answered. When is Jigsaw having footprint charts? Well, we've got them already. We're just going through QA, performance improvements, before they get all those. You can probably find this on YouTube. We'll send out a link. Can you add a module within Journalytics for going through this 2-week process? That is one of the things we want to do. One of the things that is important to record as a trader that a lot of people don't record, and we don't really have it either, is the ability to record the missed trades. Very, very important aspect to developing as a trader. After these 2 weeks, so Christine's asking, after these 2 weeks, moving on to sim, then my question is, for how long sim trading? Really good question, right? So there's a couple of ways that I want to answer this. First of all, in a prop firm, what they'll do is that they recognize in a prop firm that when you go live, your performance will degrade. So what you need to do is give yourself some ground rules and say, right, I'm on sim now. I've got my account at Davies. I'm going to let myself trade the live account at Davies when my trading hits this level, right? So you might say it's break even, or it might say you'll be trading the micros on and getting $20 a day profit. That's one way to say, right, I'm now ready to trade live money. So you have 2 sets of rules. You have one set of rules, which is a performance level you need to attain before you can trade live. And then you need a performance level that you go down to that puts you back on sim. Okay, so what will happen generally is that if they have a blowout day in a prop firm, they'll have a limit. They'll say if you go over this max limit on a day, or a max drawdown overall, if you go past that, then we'll put you back onto sim. But if you have a really crazy day where lots of people are making money, they give themselves an allowance for that. So you might have $1,000 max loss limit in a prop firm, but you lose 2,000 because, like Donald Trump says, everybody in America is going to get coronavirus, and the market just tanks, right? On a day like that, you might just hit your $2,000 loss just because you couldn't get out of your position, right? And most prop firms will say, well, no, don't worry about that one because we know why that is. That's an exceptional case. And then the other way I'd say, how do you know you should go into sim, is think of this. Let's say you've got a friend who's trading sim, right? And your friend comes up to you and says, look, you know, Christine, I'm doing really well on the simulator. I am on fire. Only trouble is I don't have any money to trade. But here's my sim results. Will you give me $20,000 to trade live? So what would you need to see in those sim results to give him the 20,000? Okay. And that's the kind of level that you should be setting yourselves before you turn the market into a casino. Because the last thing I want, and the last thing a company like Tradeovate wants, is for you to blow up your account, right? Now, what you could do, because of micros now, you could actually trade one lot on micros without doing a lot of damage to your account, as long as you've got the discipline not to. I mean, because I've seen people on micro accounts blow 5,000 in a day, just by like trying to scale up to make up for the losses. As long as you've got that discipline, micros aren't a bad thing. But I hope that answers your question. Alex asking, do you look into volatility at the beginning of the day and say it's too much for me? I look at volatility all through the day, Alex. I mean, there are times on an average day, the volatility is going to be like 9:30 Eastern, it's going to be up, and then it's going to like taper down 11 Eastern, and then quite over lunchtime, and then it's going to do its thing towards the end of the day. So that's the kind of, so I'll make allowances for that. But also then you've got like the crude inventory reports and all that kind of things, the FOMC days that affect volatility. And then you've got like kind of macro-driven volatility with major positioning like we've got now. But yeah, certainly you have to, one of the things you'll see in the 2 weeks, and one of the reasons I keep this to 2 weeks, this 2-week plan, is because in 2 weeks, you've got a fairly good chance that the volatility of the market's going to stay fairly consistent. Right. So I said, do this for a month. The chances are you're going to get some days that are kind of out of character. So we try and keep it to 2 weeks and try and keep fingers crossed that we'll be fairly consistent. But you absolutely have to look at the volatility at the beginning of each day and through the day, and keep your ears on the news so that if let's say crude spikes, because crude spikes has a lot of volume blow-offs all the day. But if you see crude spiking, you can sometimes fade that spike. But if it's spiking just because the oil inventories came out, or if it's spiking because of, like another 10,000 people got coronavirus in Italy, then you should know that like that's a news-driven event, and that volatility is probably going to be around for a while. Okay, and somebody's saying, Gene, be doing exactly what you're saying, and so if you don't see that comment, Gene saying, actually, I've been doing exactly what you're saying, and accidentally or by intuition, I found my very own setup. It's not accidentally. It's just because you're watching the market. And the thing is, when you lose, if you're sim trading, when you lose, you stop watching the market. You don't want to see it. It's a horrible thing to watch, right? But when you do it neutrally, you can watch the ups and downs of the market absolutely neutrally. And like Gene's saying, he's found a new setup. Just get through a few more questions. There's no micro for the bund yet. I wouldn't be surprised if Eurex follow up and start some micro markets. I'm amazed that CME haven't expanded it outside of the indices. I think, but Bastian might be able to answer. I think there's some microcurrencies though. So Bastian, do you know what other markets have micros?
Yeah, currently it's the microcurrencies, and the micro gold as well. And that's it for now. But yeah, like you said, hopefully there'll be some more micros in the future. Yeah,
it's an absolutely brilliant way to get onto. It's an absolutely fantastic way to go from live to from sim to live. Just start with 1, go to 2, go to 3, go to 4, and I think that's fantastic. All right, although this does depend on market trading style. If you are looking at a pure scalping approach, I would tweak it a bit, but you still need to watch the market. So I can tell you, for those who don't know, we've actually got a market making scalping manual. I'll put the link in, and it is a pure scalping approach. But I can tell you, I've sat with Gary while he's been looking at some new markets. So Gary, the guy that wrote the market making scalping manual, is a trader that's I can just show you here. He's got a very long history in institutional trading. He's a scalper. He gets in and out of trades at a tick. When he goes to a new market, he does not trade it. He just watches it. He wants to see how it's trading when size comes in. He wants to see when it's fast, when it's slow. He wants to see how it works with the correlated market. So even this guy, he won't go to a new market and just trade it. He will go to a new market and he will watch it for a few weeks. And this is a guy that's been trading since he was 18, and he's not 18 anymore, right? So yeah, even for the scalping, absolutely, because you want to be able to, you want to see how that market operates, especially around size. Is there any way you can get to reach through my monitor, click my mouse to buy or sell? That would be a great thing. There was actually, it's probably off topic, but there's actually a company trying to do that with prop traders, getting you to piggyback prop traders trades, but the technology never worked. And I think for currencies, which currency do you recommend trading the Globex session? I don't trade currencies, but what you've got to do, the Globex session is quite long, right? So you've got the Asian market that opens like just, after the US close. So obviously things like the Japanese yen and stuff like that are going to be traded up to the London Open. And then when London opens, London is the biggest place, the biggest center of foreign exchange trading on the planet. So pretty much all currencies are on. But I would say, Japanese yen would probably be a good one to start, the Aussie currencies, and then when the London Open comes in, you're going to see a lot more volume coming overall. Can you give advice on someone who struggles placing stop loss orders? Find somebody and send them a screenshot of your trades every day. You need an accountability partner. There's lots of different ways to do this. But generally speaking, if you can't place your stop, or you keep moving your stop and you don't trust your stop, one of the ways that John Grady, who's going to do the next webinar, what he recommends is, if you don't trust your stop, right, give yourself $1,000 or $2,000 to lose intentionally. And what you're going to do is you're going to put your stop in according to your rules, and you're not going to move it, and you're going to keep doing that until you've lost to $1,000 or $2,000. Now, you're not trying to lose $1,000 to $2,000 really. It's just you're trying to basically take out, you're writing that money off, and then you're looking and seeing what happens if you actually lose those stops off. So it's kind of a bit of a mind trick on yourself, but that has worked for a lot of people that I know. So just get a new account, put $2,000 in it, and just leave the stops where they are, and then just see how it plays out. Because really, it's a mental issue, not being able to give up a loss. So if you can take that out of it somehow, however that works for you, or you can make yourself accountable to somebody else for moving them. Those are all ways of being a bit more mindful of what you're doing. Right, with that, I think, Bastian, we can hand back to you to close us out.
Yep, sounds good. Well, thanks very much, Peter, for that. That was very insightful, very useful, and like you said, maybe not the best thing that people would hear, but nevertheless very useful and educational. So we really appreciate it, and look forward to having you back on again in the near future. Like you said, the next one with John Grady is going to be very good as well. So feel free, anyone here now, to sign up for that one. And yeah, if you have any questions on Tradeovate, feel free to reach out to us. You can go to our website, and there's a chat and a phone number. You can email us. So whatever works best for you. And yeah, we'd be more than happy to help. And if you have any day trader specific questions, then I'm sure Peter and his team would be glad to help you as well. So just go to his website and get in touch with him.
All right, thank you, Bastian, and thank you, everyone. And I'll close the meeting out now.
All right, thank you.
Thanks.